All novice traders think in the same way. What to do? To open positions, buy call and become on increase of share price, or, on the contrary, to buy put, thereby to expect decrease of price of this or that share. In any case, regardless of his choice, the trader risks much less capital than investing directly in the shares themselves. After selecting a particular security, the trader begins to consider for himself the options underlying that security. Suppose he has selected a stock NZ that is trading at $75 and has decided to become an upside call on that stock, thereby selecting a call for himself. Suppose he chooses a call of strike 70 from which he has a premium of $7.50 at the current stock price of $75. This call is 5 in the money, and the trader spends $750 per contract to open this position. One must realize that by buying a call option, one can only make money if the stock price rises, that the option premium will be affected by price decay and time value. An option premium will decrease from the expiration of the option lifetime, that the break-even of this position on the day of the expander is at the stock price of $77.50. Since it is at this stock price that the collab premium will equal the purchase price on the day of expiration at its intrinsic price, that if the stock goes into a sideways trend and does not reach this price, the trader will lose some money. And if it falls below 70, all the money. A young trader can be helped by a more experienced mentor who will question the success of this investment and tell about all its disadvantages. Moreover, he can give a lot of useful advice on how to save your money from a complete drain. One of such tips may not be the most productive is to create a long call spread, simultaneously with opening a long call position with strike 70. Open a short call with strike 80. In other words, buying call strike 70 at a cost of $750 per contract, and simultaneously selling call strike 80 at a premium of $2.50 will result in the trader receiving $250 per contract in his brokerage account. This is the vertical debit call spread. The total cost of the combination is reduced to $500, and the break-even of the combination is reduced to $75 on the stock price. Let's look at passable scenarios, comparing opening such a vertical call spread with opening a separate call position with strike 70. Scenario 1: the stock price on expiration day closes at $75.50. In this case, the short call with strike 80 remains out of the money and expires unclaimed. Its premium is 0. From this position, traders have a profit of $250. Call with strike 70 has a premium at its intrinsic price of $9.50. From this position, the profit is equal to $200 from the calculation of one contract. Total profit on the combination is $450 or 90% of the investment. Recall, the risk was $500. If we compare it with a separately purchased call with strike 70, the profit will be the same $200, which is equal to 27% of the investment at a risk of $750. As you can see, the vertical spread is a less risky combination than a separately purchased option call, and gives a higher percentage of profit if the stock price at expiration closes below the strike on the short position. Scenario 2: the stock has fallen into a sideways trend and closed at $75. The long call with strike 70 closes at an inside price of $5 with a loss of $250 per contract, and the short call with strike 80 as well. As in the first variant, the unclaimed one is closed with 0 premium, and the trader makes a profit of $250 from it. Total losses on the combination are equal to 0. as well as profit. Comparing with a separately bought call with strike 70, we will see that the total loss will be $250 on a single contract, as its premium will lose time value, or 33% of the total investment in this position. Scenario 3. The stock closed at expiration at $50. Both calls and vertical spread are out of the money and close at zero premium. The long call with strike 70 generates a loss of $750 per contract, while the short with strike 80 gives the trader a profit of $250. The total loss on the combination will be $500, or 100% of the investment. In this case, a separately bought call with strike 70 will bring losses of $750, or the same 100%. We have considered 3 variants of the situation. There is a fourth option. The stock at expiration closes at the price of the highest strike on a short position. For example, at a price of $85, vertical spread long call with strike 70 has a premium equal to the internal price of $15 and has a profit of $750 from the account of one contract. Short call with strike 80 is also in the money and has a premium at the internal price of $5 and brings losses to the trader. At $250 from the account of one contract, the total profit would be $500, or 100% of the investment. The profit on a separately purchased position would be $750, or 100% of the investment. The conclusion from these examples is simple. The vertical spread has limited profit, while the separately purchased option opposition, there is no profit limitation. But under an unfavorable scenario translated with DeepL, free version does not have limited profit. But in an unfavorable scenario, both options have 100% investment losses, with a vertical spread less risky as it carries less combination costs than a separately purchased option position.